We had a situation where COVID created all sorts of distortions, and not just domestically, but globally. So even after the worst part of COVID in the US, we had China, God forbid, a handful of COVID cases, and they were shutting down port cities of 20 million people, and then further clogging up the global supply chain. So we had all this supply side developments going on. We also had a massive fiscal and monetary policy response. And that's what brings us to, well, for 1 month, 9% inflation. It didn't stay there. And I guess we could all debate whether 18 months in the overall annals of economic history is transitory or not transitory. But I would say that even to the most ardent inflationists, getting a 9% even for 1 month, that was a big shock. You had monetary and fiscal policy together. It's easy to look at this in the rearview mirror because there was a point in 2020, 2021 where we thought this was the bubonic plague, and there was a massive overreaction with the benefit of hindsight. And then we had, of course, the global supply chain picture creating a lot of the cost push inflation on the production side, as you alluded to. And then on top of that, the government people not to work. You had enhanced and extended jobless insurance. And in a lot of cases, especially in the low-skilled cyclical service industry, leisure, hospitality, retail, people were getting paid more to be in the dole than they were to go back to work. So companies had to pony up a lot more on the wage side to attract people back in the labor market. So all that is in the rearview mirror, but that's the situation that we had in 2021, 2022, and in 2023. But it's interesting that, you don't hear, all the production bottleneck measures are running negative. They're back to where they were before COVID. But the real key, and of course this is what Jay Powell's been focused on, is what's happening in the labor market. Now, if you go back to that new metric that Powell basically constructed or told us to look at, which was the cyclical services, X energy, X rents in the CPI number, was not because this was some newfangled item that the Fed was targeting. It was basically really just about focusing on that particular item because it was reflecting the supply-demand imbalance in the labor market, in that part of the labor market, mostly retail and in leisure hospitality, that was most concerning to the Fed at that time. Well, it was around that time that you also heard people talking about, the participation rate will never come back. Do you remember that, the great retirement theme? You don't hear about that anymore. You don't hear about production bottlenecks. Maybe every now and again, but you don't hear a lot about that aspect of it. What you're hearing mostly about is how China is exporting its excess manufacturing capacity around the world. There was an article about that over the weekend in the Wall Street Journal. We've been writing about that at Rosenberg Research for the better part of the past year. In the product side, you've reversed course from China being a source of inflation because of the broken supply chains emanating from there. Now they're basically exporting their excess manufacturing capacity, and that's having an impact on the product sector. And the product sector is 40% of the CPI, although we focus primarily on services. But even on the services side, inflation is coming down and coming down precipitously. I don't hear a lot of people talking about sticky inflation anymore. And in fact, about a year ago, I said sticky inflation will go the way of the great retirement narrative, which is that it's going to be retired. So you've got a couple of things going on that are very beneficial for the inflation story. We can debate whether you agree or I agree with the machinations that go alongside creating the consumer price index or the PC deflator. But there's no doubt that the pressures on inflation are going down and will continue to go down, and principally from the labor market, because that's where 3/4 of the inflation comes from, is from the labor market. And so what's happened is that the participation rate for prime working age adults has miraculously gone up to its highest level in more than 2 decades. More people are out there competing for jobs, and that's putting downward pressure on the nominal wage rate. There's more people coming in for whatever reason, I imagine because now they have to, coming in looking for work and creating competition in the labor market. And that is incredibly disinflationary. It's why the unemployment rate has gone up from 3.4% on the cycle low to 4.3%. I don't think anybody would tell you that a rising unemployment rate is inflationary. It is disinflationary through prism of what happens in terms of the wage cycle. But there's something else going on that's very interesting, which is productivity. You've got productivity right now running close to a 3% annual rate. And this is before all the benefits from generative AI. And a lot of it is coming from the impact of what COVID did, because the lockdowns, the pandemic forced companies, especially in the service sector, in retail, in hospitality, that if you did not have a digital footprint, you're going out of business. You had to basically adopt an Amazon type of business model, or you were going to become defunct. And those are the areas, these sclerotic areas you don't think about. Low value add, cyclical services, parts of the economy that historically aren't that productive. That's where a lot of this productivity growth is coming from. It's actually very interesting, but productivity is totally antithetical to an inflation view, because alongside what the rising unemployment rate has done to nominal wages, unit labor costs, which is productivity adjusted labor compensation, is running close to zero. And I got all these people talking about inflation. Unit labor costs, which is the mother's milk for inflation, is running close to zero right now. And that's because of rising unemployment, which is not going to stop, at least not yet, and the acceleration we've had in productivity. So that's when I talk about looking at the supply side, because if all you did in the past year was look at the demand side, you would have missed out on the disinflation, and you would have missed out on a very impressive bond rally from the Treasury yield peaks last October to where we are today, because we no longer have a sclerotic supply curve bumping against robust demand. Demand is still robust, although the 3% demand growth, which is GDP, is now shifting more towards 2%. But the aggregate supply curve is running almost double that. And that's why you've had this situation where inflation has come down materially. And it's not just because of manipulations by government statisticians. It's real. And when I look forward-looking indicators, that's going to be the ongoing story from now to the end of next year. People say, I hear all the time, that the last leg of getting inflation down is going to be so difficult. I don't think that's true in theory or practice. And I think people will be surprised this time next year how low the inflation rate is going to be. We've gone from 9 to call it 3 in a very short period with pretty strong demand growth. Well, what happens when the demand growth slows, which we're seeing in real time? And inflation is going to melt before our eyes. And that's why I remain steadfastly bullish on the Treasury market. I'm not saying inflation is dead. I'm just saying that for now it's dormant. I'll take it a year at a time. We don't know the outcome of the election just yet. We'll have to wait till November the 5th. And then, of course, whether it's going to be one-party rule or split government. And the outlook for fiscal policy, the outlook for trade wars, tariffs. There's all sorts, what they call deglobalization. These are things I have to pay attention to. No doubt those are risks to my forecast. But my forecast right now is predicated more on productivity and where that's going, and the slack that's being developed in the labor market. I think it'd be a big mistake to take your eye off those two balls right now and probably for next year. But I think that we would have to go through a series of recurring shocks. Now, of course, nobody in the 1960s could see what was going to happen in the 1970s. But who thought in the 1970s that we were going to be facing an OPEC oil shock every 2 years, and that oil was going to go from $3 a barrel, up to $40 a barrel in a 10-year span. And we were having oil shocks every year. So if you're going to say to me, well, my crystal ball says we're going to have recurring, that Trump isn't, if he gets elected, is going to raise tariffs not just once, but he's going to raise tariffs every year. If you're going to build up a straw man, and we're in a business where your assumptions drive your conclusions. If you're going to tell me tariffs are going to go up every year, because otherwise tariffs are just a price level shift in a point in time. It's not a sustained source of inflation. People go back to the 1970s and that's all they talk about. But the 1970s, you had recurring shocks from oil, and oil back then mattered a lot more to the economy than it does today. The degree of unionization today is a lot lower than it was back then. And the first of the boomers, that 80 million picking up Python, were just starting their households. And so spending on appliances and furniture and housing and automobiles was through the roof. So in those periods where you didn't have a Volcker-induced recession, well, I guess that came earlier because he started in 79. But we had 3 recessions from 1970 to 1980. And they were induced by a reversal in monetary policy. But you see, when we weren't in recession, and we were not in recession all of the 1970s, the economy was expanding 80% of the time. And believe me, when it was expanding at over a 5% annual rate. Why? because you had vibrant demographics. We don't have the same today. And we have a much larger debt constraint in the government sector, but I think that conditions are far different. The demographics, the nature of the inflation in the 1970s, the fact that, what happened to all that talk? Starbucks gets unionized here, and you've got other unions starting there. And I was hearing this 3 years ago. You tell me what happened to that narrative, the rise of labor power and unionization. Meanwhile, despite all the headlines and all the fear mongering that went on, the share of the workforce that's unionized is the lowest it's ever been today. So no, I don't buy into that. There are risks to the disinflation. I think what happened was we got hit by a shock. We had a very aggressive policy response to the shock. And the one thing that central bankers are aware of is that they know better now than in the 70s how to fight inflation. And remember that Jay Powell, the whole way through in that tightening cycle from 2002 to the 2023, who did Powell compare himself to? You want to talk about the 1970s? Well, I asked the question, did he compare himself to Arthur Burns? No. Did he compare himself to McChesney Martin? No. Did he compare himself to anybody else other than Paul Volcker? That's all he did. And actually, it was the most Volcker-esque tightening in monetary policy since the Volcker years of the early 80s. So these central bankers know how to kill inflation. It's probably just a miracle that we haven't had the recession yet, although I still think it's going to come. But so far, we've had the soft landing. But central bankers understand inflation a lot more now than they did in the 1970s. There is I hear this all the time, we'll inflate our way out of our debts. No, that's not going to happen. We already had inflation. The debts only went up. And now the debts have become more intractable because we're spending $1 trillion a year now on interest expense on the debt. So there is no get out of jail free card. And what the politicians know, and what the central banks know, which maybe they didn't really appreciate in the 1970s, is that inflation is a tax on the most vulnerable parts of society, the low-end consumer and the elderly. So I don't see that we have an election campaign right now in the United States premised on monetary theory. Nobody talks about we have to actually have a policy of inflation or reflation. In fact, the whole thing is about how to fight inflation on a long-term basis. That's all the Trump team and the Harris team are talking about. So there's no public appetite. There's no political appetite for inflation because they realize that it ruins societies. And history shows that it actually brings down governments. So I think all the inflationistas out there, I don't have that view. Admittedly, for 18 months, I was dead wrong. It was interesting that Powell talked about at Jackson Hole about all the shipmates he had on the transitory narrative. And the reality is that I was there too, but it was temporary. If you're willing to admit that 18 months is not actually a whole decade like the 1970s.